And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's Managing Partner of Asset Preservation Tax and Retirement Services. Stewart, how are you?
I am doing wonderful this evening.
I'm so glad to see you again. I always look forward to our shows because it's an amazing amount of information that you're providing to the viewing audience. So many questions are surrounding retirement, like how do I retire comfortably, and how do I know I'm ready, Stewart, and what should I be doing right now? And I love the fact that you provide so much peace of mind and guidance to the people who are watching.
Well, thanks. I'm trying. It's hard to fit all of this into our short time, but I try to get as much info as we can to help people that's relevant,
Definitely. And I think what we should do, Stewart, somewhere along the line with one of these shows, since we do have so many viewer questions that come in, we should just spend one whole day on just viewer questions.
Sure.
Not today, but we
right.
but we definitely will. Because I do want to talk to you a little bit more in depth today just about how, people are preparing, obviously, for retirement. And so they're going to ask you questions like, Stewart, how do I know I'm ready to retire? Do you get asked that question point blank all the time?
Absolutely. And sometimes that conversation goes well and sometimes it doesn't.
Okay.
The one thing you'll get from me is my honest opinion. And, I had a client come in the other day that said, look, I'm, 61 years old. I plan on receiving my Social Security at 62. And, I'm done working. And, I had to look at the numbers and say, look, you have as much debt as you make in a year. Plus your Social Security is a quarter of what you make. It doesn't make any sense for some people because, listen, it's a lot easier to keep working from 62 to 65 than it is to go get another job at 65, 66 years old.
That's true.
It's just much harder. And I'm not saying that there's discrimination, age discrimination out there, but it happens, and it's difficult for people to get the money that they once earned, later on in life. And so I think people have to really understand where they stand financially before they make that big decision. And I think we're willing to give the truth.
Sure. Great point that you just made about knowing where they stand. I have to ask you, how important is it to carefully select your investments as you're approaching retirement?
Well, it's huge. I mean, it's the biggest thing when it comes to your retirement assets. I think that a lot of people, we have tons of clients that come to us later on in life that have been do-it-yourselfers forever. And just remember, the market, for the last 11 years has been amazing, besides the last few months here, right? But we've had this 11-year bull market. The market's darn near quadrupled from the trough, from the bottom. And, people have done well. And I think what it's done, though, is it's created a comfort level with people thinking that, that they're great investors. But remember, everybody's made money for the last decade. And I'm not trying to burst somebody's, intellectual bubble by saying that they can't do it. But times are different when we're going through volatility and crazy moves in the market compared to when the market's just kind of smoothly climbing, for a decade.
Sure. Right.
And so, I jokingly say a blind chicken could have, picked good, a winning portfolio for the last decade. But what's really separated good advisors from bad ones over the last year is how did their portfolios react when the markets became volatile, when like during the COVID drop, right? What happened with your portfolio? And what we often see with individual investors and even some of the old passive investors is that, clients will go and they'll look at like Morningstar and they'll say, oh, this is a 4-star fund or a 5-star fund. And they look at what it did in the past to see what they believe it's going to do in the future. But remember, the past performance doesn't indicate what it's going to do in the future. What we also see, which we talked about earlier, during commercial, is we talked about diversification. Yeah. And so what happens is we have clients that'll pick all 5-star mutual funds from Morningstar. But what they're not realizing, and they feel like they're diversified. They have 20 different positions. Their money's all over the place. It's not in a single place, so they feel diversified. But what's happening is oftentimes they're buying funds that all do identical things under identical situations. So what happens is if the market drops 50%, everything's going to drop similarly.
Sure.
Right? So the key to diversification and portfolio construction is to make sure that you have assets that do different things at different times. And that's what's important about understanding your portfolio. So if our assets, we may have a gold position, for example, and a S&P 500 position internally, and one may go up and one may go down, but it creates this counterbalance internally. So you can't keep up with the market if you have that counterbalance on the way up, but we're not trying to. We're not trying to beat it on the way up. We're trying not to lose on the way down.
Sure.
And so people have experienced this amazing run for the last decade. They got a reality check during COVID.
Sure.
And now we're getting tons of calls from people that say, hey, you know what? I've done it for myself for a decade. I don't want to play this game anymore.
Yeah.
Sometimes you have to take some chips off the table and, get some help.
Sure, absolutely. Stuart, do you ever recommend that people shift to more conservative investments over time?
Well, our main money manager that we use, and we use about 4 or 5 different institutional money managers, does that internally automatically.
Okay.
So we design portfolios around drawdown or loss. And so if you say, listen, I'm comfortable in worst case scenario only losing 10%, well, our portfolios automatically shift into a more dynamically safe position if things are looking, bad out there from a business cycle perspective. They will, during the COVID crash, we saw a 9.6% drawdown at the worst case scenario when the market was down 30. Yet, we saw most of the returns of the S&P, the year before.
Yeah.
So, we're not here swinging for the fences. When things look good and smooth, we get involved. When things look bad, it moves over to the side. And that's what happened, historically here with COVID.
Sure, absolutely. Do you ever recommend having short-term money safe, like an emergency fund you
Absolutely.
can pull from?
And I think that's one of the biggest frustrations some of my clients have initially is when I say, listen, you need to have, and remember, it's all relative to the other assets you have, but if I say, look, you need to have $30,000 in your checking account, sometimes they flip out and say, well, it's not making any money. Well, listen, we've got enough long-term money committed, to investments, whether it's fixed or market-driven stuff. We need to always have enough money to write a check for any problem that arises.
Sure.
Right? Because if the market's down, for example, everybody knows you buy low and sell high. And the problem is when you start needing access, it's hard to do that, right? Without a proper, fixed allocation, which we do quite often as well.
Absolutely. And Stuart, I should also ask you, are people delaying retirement now?
It's funny because after COVID, we are seeing, especially for the self-investors that took a hit there, because, going back to what I said about buy low, sell high, what we saw oftentimes is even from our own clients is they're watching the news. They may not be watching their portfolio, but they're watching the news. And, people get scared. They freak out.
Sure.
When you have a decade of an up market, you get desensitized to how difficult the market is, right? There are times where the market can drop. Well, we have clients and even prospects that have come in and they said, look, I was down 25% and I sold, I couldn't take it anymore. Well, then you just missed the whole rebound, right?
Yeah.
So people have 2 emotions when they invest. Fear and greed. It's just those 2.
Okay.
Right? The fear side says, I'm scared, I'm going to lose it all. The greed side says, I'm going to get rich, I'm going to stay in there. And it's just where your balance is that kind of determines your reactions. And oftentimes, like I was saying, we had existing clients in our portfolios where they say, look, the market's down 3% today, get me out. But they're looking at the news, they're not looking at their portfolio, right? Where we were actually up, 0.2% if the market's down 2% in some situations. And I'm saying, look, go log onto your account and look.
Yeah.
And they're like, oh, wow, we didn't lose anything. Yes, exactly. And that's why when people say, hey, the S&P's up this, 2% today and we're only up 1.5%, or the S&P's down and we're up, we're not investing in just directly in an index. Otherwise, you wouldn't need us. You could go do it yourself.
Well, I think people need you, Stuart. And you know what? It's time to open up the phone lines for the very first time this week. Can you tell the viewing audience what they can expect to receive by being one of your first 10 callers?
Sure. So for the first 10 callers, we can do a portfolio analysis to let you know what we think of your strategy. Also, how diversified are you really? We can also look at any of the ways that those mutual funds or funds internally, stocks, work together. And if you just call 833-652-7829, we'd be glad to do a portfolio analysis for you, and I'll deliver those results personally.
Thank you, Stewart. To the viewing audience at home, that number to call once again is 833-652-7829. The phone lines are now open. Once again, the number is 833-652-7829. We have to take a very short commercial break, but when we come back, we're going to have more questions and answers for Stewart about planning your perfect retirement. Please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is Managing Partner of Asset Preservation Tax and Retirement Services. Stewart, another amazing show talking about the importance, of course, of planning for retirement. Mm-hmm. First segment, of course, talked about the importance of diversifying when you're approaching the retirement years, diversifying your portfolio, if you will. But I wanted to talk to you a little bit about how the face of retirement has changed. So this is no longer like your father's retirement, if you will. People are, living longer, correct?
Well, they're living longer. Oftentimes they don't have pensions.
Okay.
So they're way more, reliant on their underlying assets than the parents were. So,
okay.
The greatest generation, as they start leaving us here, a lot is changing. They were buyers and holders, so when your dad bought, this oil stock and said, hey, keep this forever. We're in a different time now, right?
Yeah.
Technology's changed. We become dependent on different things, and I think it's way more important to be more fluid, to be able to make changes, not to be in love with any positions, like people were in the past.
Yeah.
And to have a plan, to just make sure that everything's mapped out, so that we want to create as much certainty of your success as possible when it comes to retirement.
Mm-hmm. Is it true that you only get one chance?
That's it.
You got to get it right.
My time machine doesn't work anymore, so we've got to get it right the first time. And honestly, that's why it's important to create those cash flow models that we've talked about, in other shows, where we want to actually create a complete cash flow for the rest of your life. Let's just say, you have a daughter that's going to get married in 5 years. We need to add that into the plan, right? You're going to spend 20 or 30 or 50, whatever your number is, on that wedding. We need to plan that out, and we can add all of those scenarios into our cash flow modeling, so that, my partner Judd does all of the amazing cash flow work, and he will just say, look, we need 2.2% interest for you to make it for the rest of your life. And what that does is it says, you don't need to swing for the fences. You don't need to, hit a home run. You just need not to lose.
Sure.
Right? And I think that's a super important, thing for people to understand, because truly in retirement, what we see is people that hold on to their money, especially IRAs, because they don't want to pay the tax bill for taking the money out. But the worst thing is when I have a client whose spouse has passed away, they're, 80 years old, they've got a big pile of money, they've got $1 million account. They just said, look, I wish we would have taken those trips. I wish we would have done this. I wish we would have. And that's the one thing we really push, is to really enjoy life and to just say, look, it's going to be okay. With our plan, you're going to be fine. You're not going to run out. And that fear of running out is just, it tremendously weighs on people.
Oh, sure.
So then they never get to enjoy their life's work.
No, and really the way that we look at it now is that when you hit the retirement age, your life is beginning again, if you will, because
100%.
it seems like you mentioned, Stewart, people are becoming, they're more active now than in the past. You used to always think about people retiring and they used to sit with lemonade or perhaps a chair, just kind of relax, but that's not the case anymore. So you're able to tell them, you're in great shape, go take the trip, go explore, do whatever you want to do, and that must be incredible peace of mind that you're giving to people.
Well, we try, we try to present it that way. And, in our West Valley office, we have tons of clients that are in Sun City Grand, Sun City, Portobello, and all of those clients are, a lot of them are really, really active. They like to go have a fun time.
Yeah.
But it's about taking those trips and doing those kind of additional things that people just hold back on because they don't know whether they're going to be okay. And I think it's just important to have that answer, to be very clear that no problem, we're going to be fine. We just had a great client take a trip to the Barrier Reef. It was their life goal, and we just let them know, look, you're going to be fine. Don't worry. And they said, look, if something happens to them tomorrow, they had a great life. They did what they wanted to do. And I think it's important to really kind of juice all of the nectar out of life and then have a great time.
Definitely.
And, if your goal is to leave all of your money to your kids and you want to eat dog food along the way to make that happen, well, that's your call, and we can help you accomplish that. But if you really want to have a great time and know that you're going to be fine, we can set those budgets, we can look at the numbers, and make sure that you'll be fine for the rest of your life.
I was going to say, I may have to take the Barrier Reef over the dog food.
Right?
I'm
telling
you.
you.
Just want to throw that out there.
Yeah.
Oh, goodness. So I want to ask you, Stewart, why do you feel that so many people do not have a retirement plan in place now? If they're maybe watching at home and they haven't picked up the phone to call, what do you think the main hesitation would be for people, and what are you helping to overcome?
I think people just don't make changes.
Okay.
I see clients with funds that they've had that their mother passed to them. People just, when they don't understand things, they leave things alone or they settle. And, or they have a financial advisor who all he's looking at is the funds. But there's no plan in place, right? But it goes back to the fact that it takes a lot of work. And for our financial clients, we don't charge anything additional for that planning. It's part of what it's part of our service. Everybody gets it that wants it. You just have to take the time to plan. And that's why we make sure we have great communication with our clients. We know what they want, unless they, if they're taking a 2-year trip somewhere and it's hard to have a conversation. We had a client, and I see that because I had a client that went to Africa, that took a long trip and was, completely out of communication for a while. But the plan goes on. Because the plan was in place, we already have that stuff, thought through.
Yeah.
So it's just important to have a plan, stick to it, and not to, go off course.
Absolutely. And Stewart, it's about time for us to open up the phone lines to the viewing audience again. Can you tell them what they can expect to receive by being one of your next 10 callers?
Sure. So for the next 10 callers, if you call 833-652-7829, what we'll do is we'll provide a complete analysis of your portfolio. We'll take a look at all the fees, whether it's inside your mutual funds, your stocks, any annuities that you may have. We can take a look at those costs. But that comes at no cost for the next 10 callers. And we'd love to help. Just call 833-652-7829 for that complimentary portfolio analysis.
Stewart, thank you so much. To the viewing audience at home, that number to call once again is 833-652-7829. The phone lines are open. We are looking forward to your calls. We can't wait to hear from you. We have to take a very short commercial break, but when we come back, we're going to have more questions and answers for Stewart about planning your perfect retirement. Please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today, of course, by Stewart Willis. He's Managing Partner of Asset Preservation Tax and Retirement Services. Stewart, a great show, but this is my favorite part because we get the viewer questions.
Sure.
And we've talked about that in the beginning of the show, how they keep coming in week after week. And so I'm always curious to see, because you and I are having dialogue about planning for retirement, of course, but people in the viewing audience, they're actually making notes and they have questions of their own. So I love when they call in.
Sure.
Okay, are you ready for question number one?
Let's do it.
All right. So this one says, Stewart, I am currently 64 years old. I'm retired. I have 2 IRAs. One is a precious metals IRA account. The other is a traditional IRA account. I would like to remove a portion from either of these IRAs and put it into a Roth IRA account. How would I do this for either IRA? Is it the same process for the traditional IRA and the precious metals IRA? And how much can be transferred into the Roth IRA on any given year? Stewart, I love your show. I look forward to watching each week.
Nice. Well, the answer is converting to Roth from an IRA is simply a reclassification of the tax classification. So you can do it the same way each way. We are seeing a lot of the precious metal IRAs out there where people will buy physical gold and it'll be stored somewhere. Gold has a really good place sometimes in people's portfolios. And when I mean sometimes, I mean during different parts of the business cycle. So we employ gold in similar, or in some situations that it makes sense. What we're seeing though is when there are gold vendors out there that are selling you a gold IRA and charging you a 15% commission to get in, and then a 15 or 20% commission to get out, you know, they're paying, you know, they pay you 15 below spot to get in and 15 above spot to, you know, get out. You're just losing money.
Sure.
It's really hard to recapture 30 or 40% in fees just to buy and sell, right? The nice thing about our portfolios is they have those precious metal positions at times when it makes sense. The difference is it doesn't cost anything to transact in and out inside our portfolios because we generally use a gold ETF. And there are different gold ETFs, but if you look at iShares, I was actually just at the BlackRock office and I found something out really interesting about gold. Gold is, all of their gold is at the JP Morgan facility, and they have all of these pallets of gold. And when you have gold, when somebody buys one of their gold ETFs, they simply go and grab one bar from their pallet and move it to the other. And that's why it's only 25 basis points or 0.25% in terms of fees per year on that gold. Now compare 0.25% a year to 20 or 40% to buy and sell. It's really difficult to make up for those expenses. So we're very centered on cost.
Okay.
When you can accomplish the same thing for way less cost, we think it makes sense. But converting into an IRA, there's no conversion limit. There's contribution limits, but not conversion limits. So, in a previous show, I think I told you, we had a client that converted $1 million all in 1 year.
Yeah.
And it made sense in his situation. Doesn't in all,
sure,
but in his it did. But from a limitation perspective, there's no limits on conversions, only on contributions.
Okay. Excellent answer. Thank you so much, Stewart. So our next question is, this is an excellent one. Do beneficiaries pay taxes on life insurance? That's a great question.
It is. And the answer is generally no. And I say generally because oftentimes, I won't say often, every once in a while we'll see a plan that was purchased by a company that they deducted off of their taxes. So if you're taking a deduction to purchase the premiums for life insurance, then it's taxable on the way out. Other than that, that's really the whole beauty of life insurance. It is tax-free. In life insurance is a really big part of our planning if there's any sort of legacy concerns.
Okay.
Sometimes it's the most efficient tool you can have to pass assets to the kids or the grandkids. It is very inexpensive relatively.
Okay. Thank you so much.
Yeah.
I think we have time for one more. It says, Stewart, what is the difference between a 401k and a pension plan? I'm feeling confused by these two, and I need to have some guidance.
Yeah, so what we're seeing, there's a couple employers here in the Phoenix area that create a murky, convoluted statement where it's hard to tell what's what.
Okay.
But the pension plan is what you get over your lifetime. Now, there could be a lump sum benefit, and in some cases, it does make sense to get that lump sum payment out because it'll take 25 years to break even sometimes on your pension. So we can generally beat that rate of return internally, and it makes sense to take that lump sum. But we see some other pensions that we would have to have like a 7 or 8% guaranteed rate of return to keep up. And I'll tell the client, no, you know what, leave it there. It's great. So the pension analysis is a huge part of what we do.
Okay.
It really is. But the 401k almost always makes sense in Arizona to roll over to an IRA. Now, there are some downsides in some states because of liability and ERISA and a few other things. But no, they're completely different.
So it sounds to me like, Stewart, no matter where someone's at in their life, they can benefit by coming in and talking to you. And we have less than a minute left in the show.
Yeah.
Can you tell the viewing audience one more time what they can expect to receive by calling in?
Sure. So if you call in to our number at 833-652-7829, what we'll do is that complimentary portfolio analysis. And since we just talked about it, I think doing one of those pension lump sum payout options, we could do an analysis of whether or not that makes sense. So oftentimes people will listen to their friends at the water cooler, and we see that's very, very dangerous. Give us a call, set an appointment. We'd be glad to analyze your situation and see whether it makes sense for you or not.
And definitely nothing to lose, Stewart, only everything to gain by coming in. To the viewers at home, thank you again for watching. We enjoy that you spend time with us each week. That number to call again is 833-652-7829. We hope you have a great week ahead. Be safe, be happy, be blessed, and thank you again for watching.